The majority of people are unprepared for what is about to happen. They believe that their employment or financial worth will be sufficient to shield them from this impending catastrophe. The majority of people are unaware of how important it is to find alternate ways to increase your wealth in order to support themselves and their families, because they believe that cash is a long-term solution for survival. Alternatively, cash might not be the best option for an investment. Inflation, shaky economic conditions, unforeseen political developments, economic downturns, wars, financial collapses, bad monetary policies, and other non-monetary factors all work to devalue the dollar. There is always a chance that something could go wrong at any time, regardless of how old or young you are. Preparation is the key to avoiding disaster, but do you know how or what to prepare for? The majority of people think that money is secure. Contrary to popular belief, it is the least secure because there isn't enough volatility in it. We created the Bretton Woods monetary system in 1944, which is a new monetary system. Then in 1945, we created a new international order that was primarily characterized by an American world order and a bull market for stocks. Additionally, we are used to the cycle in which the central bank may encourage debt expansion whenever there is an economic slowdown, which raises demands. And all three of these cycles phases experience this. Usually, interest rates come first. The economy grows when interest rates are decreased, but when they are zero, as they were during the 1932 debt crisis, the economy stagnates. The second type of monetary policy is when central banks print money and add liquidity to purchasing financial assets. Such purchases cause bond sellers to receive cash, and the cycle continues as they go on to buy other financial assets. But only twice have similar circumstances actually happened, in 1929 to 1932 and 2008 to 2009. Zero interest rates, money creation, and monetization, meanwhile, can only take you so far. Then there is Monetary Policy 3, which suggests that the money does not reach the population and flow to all the necessary places. In other words, it's the coordination of monetary and fiscal policies in which the central bank makes a variety of asset purchases that create liquidity and have the effect of buying and monetizing government debt. And the expansion that is currently driving the market and economy is in its late cycle. For instance, the Federal Reserve and the government produce today's market liquidity, which has a big impact on the value of money. What is the value of money, though? What happens to it? A cash investment will not be profitable. In other words, the environment affects everything. Isn't it an interesting world when interest rates are zero or negative if you only take cash into account when comparing the returns of different asset classes? Then there is the desire to create a spread with high liquidity and lower short-term rates than long-term rates. This market is created by the central bank, so it necessitates a storehouse of wealth, which is clear in all asset classes when we look at the market today. Additionally, this has important geopolitical ramifications because it will be crucial to comprehend how the distribution of wealth and bills will influence taxation and other policies as we move towards a world where the wealth gap and political gap are both common. This closely resembles the 1930s, when general inflation did not immediately rise. Instead of creating deflationary pressures, it slowly depreciates currencies. Early in the 1930s, the value of all fiat currencies decreased in relation to gold. Additionally, without a noticeable level of inflation, we typically see the same kind of phenomenon today. It looks into other financial institutions and stock markets, concentrating on specific stock classes that are similar to those in 1933. Franklin Roosevelt broke the link with gold-printed money in March 1933 and made money readily available at the exact same time the stock market reached its low point. The Federal Reserve and the Treasury carried out a similar action on April 9th. The outcome is a reflection that affects other assets like stocks and others, and the consequences of doing nothing would be intolerable. Each person, business, and government has a specific amount of income, spending, and balance sheet when it comes to the wealth gap and other issues. Defaults and restructuring happen when revenue is insufficient compared to costs, the balance sheet is insufficient, or revenue declines to unacceptable low levels. Both the general populace and various businesses can attest to this. History has repeatedly demonstrated that the severe economic downturn led to the development of ineffective monetary policies, as well as significant wealth disparities, political divides, and higher likelihood at international conflict. As a result, international disagreements over how to share the wealth pie is common. Changes in tax laws and other policies will eventually result in the dynamic we are currently witnessing. Additionally, the environment for investing will be very different from what it was in the past. Since the market's liquidity is causing all markets' excess return to decline and become insignificant in comparison to the absurdly low cash rate, think of it as a zero or very low returning asset environment. Negative real returns are thus detrimental to cash. Effective diversification requires going beyond the traditional 60-40 stock-bond mix or even the same countries, broadening that diversification to include assets that might seem unusual in your portfolio, such as gold or some inflation index bonds, and considering the currency exposure, security, and exposure as dissimilar. The majority of people mistakenly believe that cash is the least secure form of payment. The high cash production is the only reason it is not volatile, and the real return is negative. It is a tax that costs you money in the form of a possible 8% yearly financial loss. You must therefore diversify as much as you can and alter the way you perceive risk. The value of passive classes makes it possible to diversify without reducing projects' returns. Second, on top of that strategic, well-devised portfolio, any circumstances change in unexpected ways. Deviating liquidity is more crucial than ever. Consider the companies that, at first glance, seem to be successful. In the future, it will be crucial to be able to restructure, increase portfolio diversification, and place a wide range